Imagine if you took out a loan knowing from the start that you were never supposed to pay it back. Not because you're irresponsible, not because you're broke, but because the entire system around you quietly assumes you won't. That's not a thought experiment. That's modern government debt. Right now, governments around the world owe more money than they can realistically repay. The United States alone carries over $34 trillion in federal debt. Japan sits above 250% of its GDP. Europe isn't far behind. And yet, markets keep lending. Interest rates rise, then fall, politicians argue, budgets get passed, life goes on. Which raises an uncomfortable question. What if most government debt was never designed to be paid back in the first place? This matters now because debt isn't a future problem anymore. It's the operating system of the global economy. Every crisis, every stimulus package, every rescue plan adds another layer, and the math underneath is starting to strain. To understand why repayment isn't really the goal, you have to unlearn how personal debt works. When you borrow money, the clock starts ticking. There's a finish line. Pay it off or default. Governments don't play that game. When a government borrows, it issues bonds. These bonds have maturities, 2 years, 10 years, 30 years. But here's the key detail most people miss. When a bond matures, governments usually don't repay it. They roll it over. Old debt gets replaced with new debt. The principal isn't eliminated, it's recycled. This isn't a loophole, it's the plan. Think of government debt less like a loan and more like a subscription. As long as the government keeps making interest payments, the system considers everything healthy. The debt itself doesn't need to disappear, it just needs to remain believable. That belief rests on one assumption: economic growth. As long as the economy grows faster than the interest on the debt, the burden feels manageable. Even if the total number gets bigger, the economy underneath it grows too. That's how countries ran rising debt for decades without panic. But here's where the math turns dark. If growth slows, if interest rates rise, if demographics shrink the workforce, the rollover machine starts to grind. This is why governments fear high interest rates more than high debt. High debt can be hidden, high rates expose the cost. At low rates, debt feels invisible. At high rates, it demands attention. That's why central banks step in. When governments issue debt, banks buy it, pension funds buy it, insurance companies buy it. And when those buyers hesitate, central banks become the buyer of last resort. They don't call it financing the government, they call it market stabilization. The effect is the same. New money enters the system to ensure the debt can continue rolling over. This is where the idea of paying it back quietly dies. Because if the debt were ever truly repaid, fully paid down, the system would lose one of its main sources of money creation. Bonds aren't just promises, they're collateral, they're plumbing. They grease the wheels of modern finance. Eliminate too much government debt and you don't get a cleaner economy, you get a shortage of safe assets. Liquidity dries up, markets seize. Ironically, the system depends on debt existing. That's the absurd part. Politicians campaign on reducing the debt. Markets panic if it actually happens too fast. There's also inflation. Inflation is the silent partner in this arrangement. Governments don't need to repay debt in real terms, only nominal ones. If prices rise over time, yesterday's debt becomes cheaper relative to today's economy. $1 trillion borrowed decades ago weighs far less today. Inflation doesn't erase debt, it slowly dissolves it. This is why modest inflation is tolerated, even welcomed by policymakers. It's not a bug, it's a pressure valve. But this balance is fragile. Too little inflation and debt becomes heavier. Too much and trust breaks. And trust is everything. Government debt only works because people believe it will keep working. That belief allows rollover after rollover, crisis after crisis. History shows what happens when that belief cracks. Not always through defaults, more often through restructuring, currency devaluation, financial repression, or sudden inflation spikes. The debt isn't paid, it's transformed. Quietly, painfully, usually unevenly. So when you hear that governments are maxing out the credit card, that's not quite right. The real risk isn't running out of money, it's running out of credibility. As long as investors trust that the system can roll forward through growth, inflation, or central bank support, debt survives. When that trust falters, the math stops being theoretical. And here's the final twist. The question isn't whether government debt will ever be paid back, it's who will pay for it and how, when rolling it over stops feeling painless. Because in a system built on debt that's never meant to disappear, the real bill doesn't arrive all at once. It arrives slowly, quietly, through prices, through wages, through savings. And when people finally notice, the system will already be moving on to the next rollover. The unsettling question is this: if debt is permanent, what happens when confidence isn't?